Welcome to Boardroom Media. I'm Andrew Musgrave, and we're joined again this week by the CEO of XM, Peter McGuire, for the XM.com weekly market update. Pete, welcome back.
Good morning, Andrew. Thanks for the invite.
No problem at all. So a fair bit to get through today. Domestically, to start with, we had the RBA last week increase the interest rates by 50 basis points.
Yeah.
Not a huge amount of impact on the market.
No, it wasn't. And I don't think there was really a surprise. I watched with earnest. We all thought that the Aussie may bounce, the Aussie dollar that is, and it certainly hasn't. It's underwhelmed. That King dollar US dollar has just ratcheted up, and it's been a short for most traders to really enjoy shorting that Aussie dollar over that time frame.
Yeah, and I think moving forward, obviously the RBA is still indicating that they're going to hike rates, which is very different to what they were talking about 6 months ago.
Yeah.
But a little bit of commentary in the market, are they going too hard, too fast, and particularly with the mortgage rates going up and a bit of issues within the building industry.
Absolutely.
It'll be interesting how they read that in the coming months.
Well, exactly right. And, auction clearances, what's happening as far as the large developers and construction firms, some going into liquidation. So it's not a good point as far as the domestic economy here in those issues regarding real estate. And everyone, if you're a homeowner, the majority of young people do have mortgages, and the stress to Main Street is starting to be felt.
Yeah, certainly is. Moving across to New Zealand. So similar environment, really.
Yeah.
So interest rates going up, looks as though they're going to be raised again. Their housing market is a little bit similar to Australia, maybe a little bit ahead of ours, as in coming off the boil a little bit.
Absolutely, cooling down quicker than they are ahead of us. 50 basis points is anticipated. The Kiwis really running at that 60 cent sort of handle. And the overall theme, how aggressive are they going to be in the next couple of months as well? Are they front loading too quickly? So it's going to be fascinating, all the central banks, and I think they've got to have a close look at things by September or October, what the overall consensus is and what the herd is to Main Street, and if they've got inflation under control.
Yeah, well, I think Q3, Q4 this year is going to be the real telling point, I think, inflation, have they got it under control, and can they then start to sort of maybe back off those interest rate hikes a little bit? So
I think you're right.
Moving up to China, had some decent or reasonable CPI number out, which so I guess bodes well to a certain extent for Australia, but from an export perspective.
Well, it does. I mean, when you're thinking about it, only 2.5% year on year, and there it is on the chart. So it was a 5-month high. I saw the numbers drop over the weekend. It's a lot better than what we're experiencing in Turkey with 78% and Greece at 13% and the likes of many European nations and Eastern Europe running close to 20%. So 2.5 we can live with certainly in China. What that's going to be as far as a proxy, do we see an increase to the value of the Aussie dollar and the overall mood to the upside? So it's, we're taking on board the numbers, and there's a fair bit to happen this week.
Yeah, and I think with the Aussie dollar as well, I think obviously commodities play a huge part in that. So if there's an uptick
100%.
in the commodities, obviously that should support the Aussie dollar to a certain extent. So we'll move into the Eurozone.
Wow.
Plenty of activity there on a whole range of fronts, but generally it's not too flash.
No, it's not. I mean, it really is a wow. When you're looking at inflation there, and that gives you a headline, that blue number. So we're running there over the 8.5% for Europe. Lagarde's coming out, and we're going to see a rate rise of 25 basis points. But as we speak, and I can't believe it, we are now at parity, Andrew. US dollar euro right this minute is right on bang parity, and it's just incredible. What we've seen as far as the devaluation of that euro over that 6 to 8 month period has just been unbelievable for a trader.
Yeah, no, and it's and you look at the euro. Obviously, you look at sort of as you say at parity. You look at what's happening in Britain at the moment.
Yes.
Like once again, not too much positivity there. The Boris Johnson situation,
Saga.
whether or not that's good or bad is,
or whether it's played out yet.
Yeah, exactly.
Who's filling in the batter up. So it's like, who's coming in today. And when you're thinking about the euro, it's been destructed. It's absolutely just hemorrhaged. And how much further, and I'm not going out there on a limb and saying, but I won't be surprised. I know this is really who could have forecast 95 of that euro, 0.95 against the US dollar? That's how strong King dollar is. And I think that, the way that Powell is and the Fed, they're far more aggressive than what Eurozone is. Yeah. And this is all going to impact as far as that huge trade surplus that Europe traditionally has cratered as far as their economic power. Yes. So that's all gone. So it's going to be fascinating how the euro plays out.
Yeah. And there's a whole range of factors there at the moment. Yeah. So, and we might sort of, in closing, let's move on to the US.
Yeah.
Non-farm payrolls, which was a decent number last week.
Good number, 372,000. We had 260,000 as the analyst. I don't even go out there anymore and say what we think it's going to be, because you can be out, and there's an example. The consensus was 260,000. They hit 372,000. Not far off May, it was adjusted back to 384,000. So it's fairly strong.
Yes.
And that's a good sign for unemployment. You want a job in the States, you'll get one. You want a job in Australia, you'll get one.
Yes.
Yeah. And so no one can say, well, I can't get a job. There is a job.
No, and that's an interesting dynamic when they were talking about a potential recession.
Yes.
Where you've nearly got full employment, which is sort of a bit contradictory.
It is. I mean, I went to business school down the road here at UTS, and you'd say that to a professor and they'll argue all day long, well, you can't have a recession when you've got full employment, you can't have this, can't have that. The counterbalance to that, or the counter argument is, this week we've got the big banks in the US, Q2 earnings are going to drop, man. Yep. And I'm really looking forward to seeing how those go as far as earnings. And as they run through all of those large S&P 500 firms, it's going to be a little bit of an inhale, and I'm not sure what we're going to exhale.
Yeah, well, that's the interesting thing where obviously inflation's, well, whether or not it's the main game in town at the moment, it's probably still up there with talk of recession, and obviously the dollar. That's still running hot. Inflation numbers are coming out in the US this week.
Yeah.
Will it be around that 8.5 still, or is it starting to ebb back a little bit?
I don't even want to go out there and forecast. All I know is you've had huge uptick as far as food prices, energy prices, construction goods, everything as the services sector in the States, everything's costing more. And I talk a fair bit to different colleagues in the States, and everyone, nearly prefaces the conversation how expensive things are. So I don't know. I won't be surprised if you see a 9+ handle over this summer period.
Yeah, wow. That's that'll be interesting to see how that gets handled from the Fed's perspective. So
will be.
But as you said, obviously earnings season starts again.
Oh, it's exciting.
This is probably the most critical one for quite some time. I suspect to see of the impact of what has happened earlier in the year.
100%.
How much are those earnings affected, which obviously in turn affects the equity markets.
Absolutely, and I'd be interested to see, I'm just, again, the business school perspective, if you're running your earnings at 5 to 6%, then you're looking at your PEs around about 18 to 19, 19.5 to 20. So you've got to think, right, how are they? And with that big pullback that we've seen as far as US equities, that'll make the PE ratio far more appealing. Yes. And depending upon where you're buying money at, what that's going to do on Q3, Q4 moving forward.
Yeah. And I think if that equity market, particularly in the US, comes back a little bit more, some of those big global US companies that have incredible earnings and incredible free cash flow, like if they're off 20, 30%.
It's a bargain hunting.
It is. And the money, you sort of think from a asset manager's perspective, some of that money, the money sitting on the sidelines at the moment, will eventually flow back into those big 100%. Global companies.
The dry powder, and this is what it's all about opportunity, and it's all about identifying a market where it is, and that's what traders do. And the old surprise, you don't want a surprise in these markets. And you don't marry a trade. And I think, and that's how fund managers work, they just go, right, it's tanking, let's get the hell out of there.
Yeah, that's right, so it'll be interesting, like a very, as you say, it starts this week, the earnings season with the banks. So.
Banks, I think Thursday, Friday. I'm really looking forward to it. I mean, they're the sort of things that I stay up. I like watching Wimbledon, but I also like watching CNBC at 3 o'clock in the morning going, wow, Bank of America just dropped, boom.
And it's nice, you get those obviously on a quarterly basis in the States, whereas here it's only sort of full year, half year sort of thing.
That's right. Oh yeah, it's quite incredible because of the vastness of the US earnings season and what that really represents to traders.
Yes.
Sector specific. I'm looking forward to seeing how healthcare goes. I'm curious to see financials, and of course, what's happening as far as the hospitality industries and how those service providers work in that, hotels as well.
Yeah, and I think also the retail, you'll see the likes of the Walmarts, the Nikes, those sort of things. If their earnings have been affected, then does that sort of indicate that the US consumer is starting to put their hands in their pockets and just peg things back a bit? But time will tell.
Yeah.
So, all right, just to finish off, the US dollar is the main game in town.
108 to that US dollar index. So for all the traders out there, they've got to study that number. That's the first number I look at each and every morning is US dollar index. That sets my day. And that US dollar we haven't been to these numbers since 2001, 9/11, and it went to 120, that US dollar. But it's at the moment, there's plenty of upside and the horsepower moving it forward. That's demonstrated by euro coming to parity. Have a look at the yen, 137. It's just and the pound's crumbling. Aussie's crumbled, and the Canadian dollar and the Kiwi.
Yep.
So yeah, there's so much opportunity, and you just see that red line there, dollar index, and it just goes like hello.
Yeah.
It's just incredible.
Yeah.
I mean, and the yen.
Yeah.
If you've got US dollars under the bed, you want to go anywhere, travel to Japan, you're going to have a great holiday.
Good stuff. All right, Pete. Well, that's another good market wrap for this week. Plenty coming out, so we'll regroup again next week.
It's an exciting week. Thank you again, Andrew.
Excellent. Thanks, Pete. Cheers.
Cheers.
Okay.